10 rupees, 1 cup of tea, 1 QR code. A customer lifts a phone, scans, enters a PIN, and hears a tiny confirmation sound. The tea seller keeps pouring. No cash changes hands, no card machine appears, no bank employee is involved. Yet money has moved from one bank account to another in seconds. The strange part is not that this is possible. The strange part is that it feels completely ordinary. In July 2026, UPI processed about 23.6 billion transactions in a single month. That is roughly 8,800 payments every second on average. So here is the question for this story. How did one of the most complicated activities in finance become so cheap, so fast, and so invisible that a 10 rupee payment barely feels like an economic event? The easy explanation is that UPI made digital payments convenient. True, but shallow. A better question is, what did convenience replace? Before UPI, India already had cards, bank transfers, wallets, and internet banking. Digital money was not new. What was missing was a common, low friction way for almost any bank account to pay almost any other bank account through almost any compatible app. Think of the old payment world as many private roads. Your bank had one road, a wallet had another, card networks had their own rails. Each road had its own entrance, rules, and economics. UPI did not simply build a prettier vehicle, it helped create a common junction. And once the junction became cheap enough to use, the smallest useful payments started shrinking. Imagine a roadside merchant before QR payments became normal. To accept cards, the merchant typically needed an acquiring relationship, a physical terminal or similar acceptance device, connectivity, onboarding, and a fee structure built around a formal card ecosystem. RBI itself distinguished between physical point of sale infrastructure and cheaper asset light QR infrastructure when it rationalized debit card merchant fees. The point is not that a 10 rupee card payment was technically impossible. It is that the acceptance stack was oversized for millions of tiny, informal, high frequency transactions. Cash had a brutal advantage. It worked instantly, offline, with no device at the counter. Digital payments had to become easier than cash at the edge. A printed QR code changed the economics of that edge. The merchant did not need a card reader for every cup of tea. The customer already carried the expensive machine, the smartphone. UPI launched in 2016 and is operated by the National Payments Corporation of India. At the user level, it looks simple. Underneath, several actors cooperate: the app, payment service providers, the payer's bank, the receiver's bank, and NPCI's payment infrastructure. But the most important design choice is interoperability. You can use one UPI app while the person you pay uses another. Your bank can be different from theirs. A QR code can route the payment without forcing both sides into the same private wallet. That sounds boring. It is not. Interoperability changes competition. Apps can compete on experience while sharing the underlying payment language. The network becomes more valuable without requiring one company to own every participant. In systems built as closed gardens, the platform often needs both buyer and seller inside the same ecosystem. UPI separated the rail from the storefront. Now we reach the deeper economic idea. Every payment system has a minimum practical transaction, even if nobody writes it down. Below some value, the effort, fee, hardware, waiting time, or social awkwardness makes the payment not worth doing digitally. UPI pushed that practical floor downward. When paying 10 rupees becomes almost as easy as sending a message, people stop reserving digital payments for important purchases. They use them for tea, autos, vegetables, parking, a share of dinner, a payment to a domestic worker, or money collected from five friends. This is why one statistic matters more than a giant rupee value. In March 2024, BS researchers noted that UPI was already 81.8% of India's digital payment volume, but only 8.7% by value. In plain English, UPI's dominance was being built from an ocean of relatively small transactions. Lower friction does not just move existing payments from one channel to another, it can change behavior around the payment itself. Splitting a restaurant bill no longer needs mental accounting and later reminders. A small merchant can accept money without keeping change. A group can collect money without one person becoming the unpaid accountant. A recurring payment can be authorized through UPI autopay. These sound like tiny conveniences. Put millions of them together and the economy develops a new habit. Just send it now. RBI's latest nationwide survey, covering more than 30,000 users and 10,000 merchants, found that speed and convenience were the main reasons users adopted digital payments. 67% of surveyed merchants accepted digital payments, and UPI was the predominant mode. Infrastructure changes behavior when it removes a repeated excuse to delay, round off, avoid, or abandon a transaction. This is where the story stops being only about payments. When you scan a stranger's QR code, you do not personally know their bank. They do not know yours. You may not even use the same app. Yet both sides act as if the system will recognize the destination, authenticate the payer, move the money, show a status, and provide rules for what happens when something fails. That is a form of shared institutional trust, not blind trust in the person, trust in the protocol around the person. A useful way to think about UPI is as a transaction grammar. The QR or UPI address says where, your PIN says you approve. The banks hold the money. The network carries the instruction. Common rules let different companies understand the same sentence. The real product may therefore be larger than instant payment. It may be cheap, interoperable trust between participants who do not need a prior relationship. Payments are a network business. A payment method is useless if nobody accepts it. Each new user matters more when more merchants are reachable, and each new merchant matters more when more users can pay. Closed platforms can create this effect too. Alipay and WeChat Pay transformed China. M-Pesa transformed Kenya. But base research describes those systems historically as more closed loop or platform centered. UPI's unusual bet was that the network effect could live in shared infrastructure, while private apps fought above it. Brazil's PIX later showed a related public infrastructure logic. Open participation and interoperability can push prices down while preserving competition at the edges. This is why architecture is policy. If every Indian payment app had required its own merchant QR and its own balance, the market might have produced multiple powerful islands. Instead, UPI tried to make the water between the islands navigable. A cash transaction can vanish from the formal record the moment it happens. A digital payment leaves a trail that can make previously invisible business activity more measurable. RBI research argues that digital trails can reduce information gaps in credit appraisal. Global World Bank research published in 2026 found that firms receiving electronic payments were less likely to be credit constrained, especially small and young firms with weak traditional records. But this needs a warning label. A UPI history does not automatically become a magic credit score. Access depends on consent, data governance, lender models, and other financial information. And measurement can cut both ways. More visibility may help a small business prove revenue. It can also increase concerns about surveillance, data use, and exclusion. The deeper lesson is that when payment becomes digital, the transaction creates two products, money movement and information about economic behavior. Now, the central contradiction. UPI feels free. The infrastructure is not. Servers cost money, fraud systems cost money, customer support costs money, banks, payment service providers, and apps all operate pieces of the chain. So, who pays when the merchant and customer do not? Since January 2020, policy has made MDR, the merchant fee, zero for prescribed UPI payments. The government has also used incentives to support the ecosystem. For financial year 2024 to 25, it approved a Varsan 500 crore scheme for low value UPI merchant transactions. Eligible payments up to RZ 2000 to small merchants received a 0.15% incentive distributed through the acquiring side of the system. This is the crucial distinction. Zero price to the user does not mean zero economic cost. It means the cost has been moved, shared, subsidized, cross-sold against, or accepted for a larger public objective. Friction is annoying, but some friction protects us. The easier it becomes to push money instantly, the more valuable social engineering becomes. A fraudster does not always need to break the payment rail. They can persuade the user to authorize the payment themselves. RBI now calls this the continuing challenge of authorized push payment fraud. And here is the irony. In its 2026 to 27 agenda, the RBI says it will explore introducing certain frictions into digital payments to improve customer protection and recovery. The system spent a decade deleting friction. Now, it may selectively add some back. This is not failure. It is a reminder that good infrastructure does not minimize friction everywhere. It minimizes useless friction while preserving protective friction. There are other limits too: outages, weak connectivity, digital literacy gaps, smartphone access, and the fact that cash remains a resilience layer when electronic systems fail. UPI is interoperable, but the consumer facing market is still concentrated. In May 2026, PhonePe and Google Pay together handled about 79% of UPI transaction volume. That creates another contradiction. A shared rail can encourage competition, yet network effects, habit, distribution, and marketing can still concentrate the apps people actually use. NPCI has spent years trying to address this with a proposed market share cap. The point is not that interoperability automatically produces perfect competition. It changes where competition happens. Control over the underlying rail is different from control over the front door. For India, the open question is whether the ecosystem can keep the rail widely accessible while preventing the user layer from becoming too dependent on a few giant apps. Shared infrastructure reduces one kind of lock in. It does not repeal economics, and in August 2026, the argument came full circle. India moved closer to creating a legal basis for merchant fees on some UPI payments. No final fee structure has been decided. Proposals being discussed would try to preserve free payments for consumers and small merchants while charging some larger merchant transactions. Whatever policy wins, the debate exposes the hidden economics that the user interface concealed. The country first needed to make digital payment cheap enough to become a habit. Once the habit reached enormous scale, the question changed from will people use it to how should we finance it sustainably. That is a very different stage of infrastructure. Roads, electricity grids, and telecom networks face versions of the same problem. Adoption is only chapter 1. Eventually, someone must pay for maintenance, resilience, security, and improvement. We turn to the tea stall. The customer scans. The seller hears the confirmation. 10 rupees moves. Nobody thinks about interoperability, settlement, acquiring economics, fraud infrastructure, or policy. That invisibility is the achievement. But the deeper story school lesson is not UPI is successful. It is this. When the cost of an important interaction falls far enough, behavior changes before people notice the system changed. The internet made publishing cheap. Cloud computing made servers rentable by the hour. GPS made location a free input to thousands of products. UPI helped make bank to bank payment feel almost like sending a message. The next economic value often appears not inside the infrastructure, but in all the ordinary actions people start taking because the infrastructure is there. The strongest systems do not merely make an old action faster, they lower the threshold at which the action becomes worth doing.